What if the battery in your next car could trigger a supply crisis so severe that it sends silver prices to $150 an ounce within months? Markets will behave like they always do when game-changing technology collides with structural supply shortages, with violent repricing, panic buying of physical assets, and a scramble that leaves those who understood early positioned for generational wealth while everyone else watches helplessly as opportunity evaporates. If you were checking your retirement account in January 2026, everything might look normal on the surface. Stocks holding steady, bonds paying interest. But what you cannot see, what almost nobody is talking about yet, is that Samsung announced it was preparing to take its long-anticipated solid-state batteries to market, with a trilateral agreement between itself, BMW, and American battery expert Solid Power in late October. And these batteries, these revolutionary power supplies that charge in 9 minutes and last 20 years, have a secret ingredient that could detonate the silver market like nothing since the Hunt brothers tried to corner the market in 1980. Samsung's ASSBs use a silver carbon layer as the anode and a nickel manganese cobalt material for the cathode. Not a little bit of silver for electrical contacts like current EVs. A typical 100 kilowatt electric vehicle battery pack adds up to roughly 1 kilogram, about 1,000 grams, of silver per car 1 kilogram, 32 troy ounces per vehicle. And when you combine that with China's export halt that has already choked off 60 to 70% of global refined silver supply, you are looking at what traders are calling Silvergeddon, a perfect storm that could send prices surging to $150 or higher before most people even understand what hit them. Let me take you through how this technology actually works, because understanding the mechanics is critical to grasping why this is not hype, but mathematical inevitability. With an energy density of 500 watt-hours per kilogram, they are twice as dense as conventional lithium-ion batteries, smaller, lighter, safer, capable of driving 600 miles and charging within 9 minutes. Compare that to current EVs that charge from 10 to 80% in around 45 minutes, with a range limit of 300 miles. Samsung's ASSBs use solid electrolyte instead of liquid electrolyte found in a lithium-ion battery, offering superior safety as they are not flammable, and last for 20 years or 2,000 charge discharges, equating to 1.2 million miles. The silver carbon composite layer serves multiple critical functions. It prevents dendrite formation, those tiny metallic whiskers that can short-circuit batteries. It maximizes electrical conductivity. It stabilizes the entire system under extreme temperatures and charging speeds. You cannot substitute copper or aluminum here. Silver is not optional. It is essential to making the technology work. Now here are the numbers that should terrify anyone who understands supply and demand. Global car production stands at about 80 million vehicles per year on the low end. And if just 20% of these vehicles were to adopt Samsung's solid-state batteries, the annual demand for silver would be around 16,000 metric tons, representing a significant portion of current global silver production, which is approximately 25,000 metric tons annually. Think about that. 20% adoption, just 1 in 5 vehicles globally, consumes 64% of annual silver mine production. And that is a conservative estimate. The penetration of solid-state batteries into the auto industry could be as high as 50% or greater in the coming years. And that means the demand for silver from the EV industry alone could consume the entire annual production of the world. The entire annual production, not leaving a single ounce for solar panels, electronics, AI data centers, medical devices, or any other industrial use. The math simply does not work. But wait, it gets worse, because Samsung's battery breakthrough is not happening in isolation. It is colliding with the China export crisis that has already sent physical silver premiums exploding. On January 1st, 2026, China implemented strict export licensing requirements for silver, effectively locking 60 to 70% of global refined silver supply behind the Great Wall. China is the world's largest refiner, even though they do not mine the majority of it. They import raw silver from Peru and Mexico, refine it in massive facilities, and historically exported significant portions back to Western markets. That pipeline got choked down to a trickle. Why? Because China needs that silver domestically for their own solar panel manufacturing, EV production, and AI infrastructure build-out. And while COMEX futures in New York quote silver at $90 to $95, physical silver in Shanghai is trading at $10 to $12 premiums. In Tokyo, premiums hit 60% in some secondary markets. In Dubai, transactions are clearing above $100 for immediate delivery. The paper price and physical reality have completely divorced. As of mid-December 2025, the silver spot price has traded as high as $69.51 per ounce, up sharply from approximately $30 to $32 earlier in the year amid industrial strength and deficits, and up an astonishing 141% year to date. 141% in 1 year. That is not normal precious metals behavior. That is crisis behavior. That is what happens when genuine supply shortage meets unstoppable demand growth. And Samsung's battery rollout has not even started yet. Under the trilateral agreement, Samsung will supply ASSB cells featuring the solid electrolyte developed by Solid Power to the German automotive group BMW, which will then develop modules and packs for ASSB cells to fit into their next generation evaluation vehicles expected in late 2026. Late 2026. This year, production vehicles targeting premium segments before trickling down to mass market models by 2030. Let me explain this in simple terms like I'm talking to my nephew over backyard burgers. Imagine there is a super popular new video game console that everyone wants, but to make each console, you need a rare mineral that is only mined in a few places. Right now, factories around the world use that mineral to make phones, computers, and solar panels. There is barely enough to go around. Now suddenly, car companies announce they need 1 kilogram of that mineral for every electric car battery, and they plan to make 16 million cars per year using this technology. But the entire world only produces 25,000 kilograms total annually. What happens to the price of that mineral? It explodes, because everyone who needs it, car companies, phone makers, solar panel factories, they all start bidding against each other, driving the price up until either some people stop buying or miners can produce more. But mining takes 7 to 10 years to increase, so in the short term, prices just keep going up. That is exactly what is about to happen to silver. The supply side is absolutely broken and cannot respond quickly. The silver market is simply not prepared for this level of demand, and the consequences will be explosive and far-reaching. Global silver demand already reached 1.17 billion ounces in 2024, while mine production was only 835 million ounces, creating a 335 million ounce deficit. 5 consecutive years of deficits have cumulatively drained 820 million ounces from above-ground inventories. COMEX registered silver available for immediate delivery has fallen 70% since 2020. When Samsung's batteries hit mass production and auto manufacturers start ordering 16,000 metric tons annually, where does that silver come from? There is no stockpile sitting idle. There is no excess production capacity. Mines operate at 85% capacity utilization, with lead times for new projects exceeding 10 years. Even if silver hits $150, you cannot just flip a switch and double mine output. If widespread adoption begins in 2027, short-term supply shocks could push prices to $100 to $150 per ounce, as fabricators and investors hoard physical silver. And in extreme scenarios with high adoption plus persistent deficits, prices could reach $200 per ounce or higher. This is not speculative fantasy. This is analysts running the numbers on documented battery silver content, multiplied by confirmed production timelines against known supply constraints. Analysts warn this could strain already tight silver supplies further, fueled by industrial uses in solar panels, AI, and military tech. The solar industry alone consumed 200 million ounces in 2024 and is projected to hit 250 million by 2030. AI data centers are adding massive electricity demand, with 80% preferring solar tie-ins that require silver paste. Military applications for silver in electronics, targeting systems, and communications are classified but substantial. So what should you do? How do you position yourself when the biggest battery breakthrough in decades is about to collide with the tightest silver supply in modern history? First, understand that this is not about getting rich quick. This is about recognizing a structural shift in industrial demand that the market has not fully priced in yet. If you have zero physical silver exposure and you are in your 40s, 50s, or 60s trying to protect retirement savings, a 5 to 10% allocation to physical silver makes sense given these fundamentals. Not paper silver, not ETFs that may not be redeemable during crisis, physical coins or bars stored securely. Second, expect extreme volatility. The path from 95 to 150 will not be smooth. There will be corrections of 15 to 20% that shake out weak hands. Regulators will try to suppress prices through margin hikes. Media will tell you the rally is over. Ignore the noise. Focus on supply-demand fundamentals. Third, understand timing. Samsung SDI CEO stated preparations for mass-producing next-generation products of various form factors, such as an all-solid-state battery, are well underway, as they are set to lead the global battery market with unrivaled supergap technology. Production is ramping now. By late 2026, first vehicles hit the road. By 2027 to 2028, broader adoption begins. That means the next 12 to 24 months are critical positioning window before mass awareness hits and premiums explode further. Fourth, do not overallocate. 10 to 15% maximum in precious metals for most retirement portfolios. You need income, liquidity, diversification. But 0% allocation to hard assets during this technological inflection point is financial malpractice. Fifth, recognize this is different from previous silver rallies. In 2011, silver hit $49, driven by quantitative easing fears and investor speculation. That was sentiment-driven and crashed 70%. This time, the driver is genuine industrial demand that cannot be delayed or substituted. Car companies cannot build 600-mile range batteries without silver. Solar manufacturers cannot make efficient panels without silver paste. AI data centers cannot function without silver in circuit boards and capacitors. This demand is inelastic and accelerating. At full adoption with 80% market share, EV batteries alone would consume 64,000 metric tons of silver annually, 2.5 times current global production. That level of demand imbalance forces violent repricing until equilibrium is reached at much higher price levels. The China export halt removes any buffer that might have cushioned this transition. In previous supply crunches, Western markets could tap Chinese refined silver. That option is gone. Beijing has elevated silver to strategic material status like rare earths, ring-fencing supply for domestic use. The annual consumption is higher than supply, so even now there is no silver that can be used in these batteries. The deficit exists before Samsung's demand even hits. When 16,000 metric tons of annual battery demand lands on top of existing 300 million ounce shortfalls, something breaks. Either prices surge to ration demand, forcing some industrial users to cut consumption or find substitutes, or production simply cannot meet orders and manufacturers face allocation. This is what happens when decades of underinvestment in mining, flat production since 2016, depletion of above-ground stocks, and explosive new technology demand all converge simultaneously. Silvergeddon is not fear-mongering. It is mathematics. Samsung's AI-powered solid-state batteries represent the future of transportation and energy storage. 600-mile range, 9-minute charging, 20-year lifespan. These specifications will become industry standard because competitive pressure forces it. Every automaker will need equivalent technology or lose market share, and every equivalent technology will require massive silver content because the physics of electrical conductivity does not change based on brand. Whether it is Samsung, LG, CATL, Panasonic, or any other battery manufacturer, if they want 500 watt-hours per kilogram energy density with ultra-fast charging and 2,000 cycle lifespan, they need silver in the anode. There is no substitute that delivers the same performance. Markets will behave exactly as they always do when unstoppable industrial demand meets immovable supply constraints, with panic, hoarding, price explosions, and wealth transfer from those holding depreciating paper to those holding appreciating hard assets. The $150 surge is not the ceiling. It is the floor if adoption curves track anywhere near industry projections. Long-term equilibrium might settle lower if alternatives emerge such as silver-free anodes or mining ramps up, but structural demand growth favors sustained highs. Those alternatives are theoretical. The demand is real and happening now. Position yourself before the crowd figures out what Samsung's battery breakthrough really means for the silver market. Because when Silvergeddon fully manifests, when auto production lines are idled waiting for battery silver that does not exist, when spot prices gap $50 overnight as physical premiums explode, it will be too late to protect your nest egg at reasonable prices. The leaked battery specifications, the China export halt, the $150 target, these are not predictions. They are inevitabilities. Act accordingly while there is still time.